For most of the past 2 decades, the global economy lived under the belief that money would always remain cheap. Low interest rates shaped how governments, corporations, and investors made decisions across the entire world. Borrowing became effortless, risk-taking became normalized, and debt slowly faded into the background of the system. Growth was no longer something that had to be earned, but something markets simply expected to happen. That environment trained an entire generation to believe central banks would always provide support. Whenever markets weakened, interest rates fell, and liquidity returned almost automatically. Over time, emergency measures stopped being temporary solutions and became permanent foundations. Cheap money was no longer a response to crisis, but the default condition of the global economy. Governments learned they could borrow heavily without facing immediate consequences. Companies expanded rapidly without proving sustainable profitability. Investors chased returns without fully pricing long-term risk. But the world that supported this behavior no longer exists. We are now living through what many economists describe as the high-rate era, a period where money is expensive, selective, and no longer easily available. And this shift is doing far more than simply slowing inflation. It is quietly reshaping the structure of the global financial system. To understand why this matters, we need to look at how unusual the previous era truly was. After the 2008 financial crisis, central banks cut interest rates to near zero. The objective was simple: prevent systemic collapse. And for a time, that strategy worked. Financial markets stabilized, credit flowed again, and confidence slowly returned. But the emergency policies never fully ended. Instead, they became embedded into the architecture of the system. For years, borrowing felt almost free. Debt could be refinanced endlessly, risk could be pushed forward into the future. This environment rewarded speed over stability. It rewarded expansion over discipline. And it rewarded promise over performance. Slowly, the global economy became structurally dependent on cheap capital. That dependency is what makes today's shift so powerful. When inflation surged after the pandemic, central banks had little choice. They raised interest rates aggressively and at historic speed. The Federal Reserve led the move. And because the US dollar anchors global finance, the effects spread everywhere. Higher rates did not only cool domestic demand, they redirected global capital flows. Suddenly, US assets offered something rare: safety with yield. Money began flowing back into the dollar. Emerging market currencies weakened. Dollar-denominated debt became harder to service. Financial pressure expanded far beyond American borders. But the most important impact was structural, not cyclical. High interest rates expose weaknesses that cheap money hides. Companies dependent on refinancing were forced into reality. Business models built on permanent funding began to crack. Cash flow mattered again. In the technology sector, the change was immediate. Valuations once driven by distant potential now faced present earnings. Layoffs followed across industries. Spending slowed, and efficiency replaced expansion as the new corporate priority. Governments felt the shift just as strongly. Public debt levels had exploded during the years of low rates. Servicing that debt once felt manageable. That equation has now reversed. Interest costs are rising at alarming speed. In the United States, debt servicing has become one of the fastest-growing government expenses. In other countries, the pressure is even more intense. Japan carries one of the highest debt-to-GDP ratios in modern history. For decades, low rates made this burden survivable. Even small increases now carry massive consequences. Europe faces similar tension between fiscal reality and political promises. Emerging markets face the toughest constraints of all, because when money becomes expensive, access matters more than ambition. This is where the high-rate era becomes a story about power. Nations with reserve currencies gain flexibility. Those without them face narrowing options. The strength of the dollar reinforces this global imbalance. Capital flows reshape priorities across continents. Some economies absorb higher rates with discomfort. Others experience them as crisis. Beneath it all lies a deeper transformation. For years, markets were conditioned to expect rescue. That confidence is now being tested. Inflation limits how quickly rates can fall. Geopolitical tension amplifies uncertainty. Supply chains are being rebuilt rather than optimized. And old tools may no longer function the same way. Rate cuts, when they come, may slow pressure rather than remove it. This raises a difficult realization. The high-rate era may not be temporary. It may represent a new baseline. If so, investment behavior must fundamentally change. Leverage becomes more dangerous. Short-term speculation loses power. And resilience becomes the defining advantage. Real assets gain relevance again. Cash flow regains importance. Risk is repriced across the entire financial system. Individuals feel this shift whether they follow markets or not. Credit tightens, costs rise, and financial decisions become heavier with consequence. Interest rates are not just economic numbers. They are signals about confidence, power, and scarcity. They reveal where trust still exists, and where it quietly erodes. The biggest shifts in finance rarely announce themselves loudly. They unfold gradually beneath the surface of daily headlines, until one day the system feels unfamiliar. And by then, the transformation is already complete.